Good morning and welcome to the NZ Funds Monday Call. I'm your host, Stefan Clark. This week we're joined by Rowan Simpson, founding member of Trade Me and Xero and veteran of Vend and Timely, among other successful technology stories from New Zealand. Having been at the front line of driving some of New Zealand's largest tech stories over the last 2 decades or so, Rowan has recently published a book on how to be wrong, a crash course in startup success, to share his journey and his learnings with us. Hey, Rowan, it is a delight to have you here. I'm very excited about our conversation today. I thought we could kick off with your journey at Trade Me. I believe you were employee number 3. How did you get involved and what were the early years like?
Yeah, number three. I like to say I was the first employee whose surname wasn't Morgan because Sam, obviously the founder, hired his sister Jessie as soon as he had some funding, and then I was quickly hired after that. So, yeah, I mean, it was a slightly indirect route in. I actually had my own startup that I was working on back then. This is late '99, early 2000, so a long time ago now, Stefan. But I had a site that I had built called Flat Hunt, which was a classified site for rental property, effectively. And I'd gotten that to about as far as I could take it as a one-man band, and started to do some contracting work actually to pay the bills on the side. And one of those contracts was helping Sam and Jessie, who'd just joined the team herself, to do some software engineering at Trade Me, as that was starting to ramp up back in those days. So.
In your book, you sort of build up the story of Trade Me, and you talk a fair amount about this idea that these things are by no means an overnight success. How did it go from 3 to 4 to very, very many in a nationwide sort of it's part of the New Zealand infrastructure, if you will?
Yeah, it's one of those questions I used to get asked a lot after people were more familiar with the success of Trade Me. So looking back, people would say, how did Trade Me get so big? And the honest answer is one member at a time. And in the beginning, literally one member at a time, right? So yeah, I mean, one of the things I think we don't do an especially good job of in the startup world especially is telling the actual stories of these companies and how they grow. We tend to focus on the success stories at the end of their journey rather than the route that was taken to get there. And Trade Me is a great example of that. It was very indirect, and there were a lot of missteps along the way. And one of the delights in writing the book has been able to share some of those stories, because for me, actually, those are much more interesting stories than the sort of up and to the right runaway success. As you say, overnight success. Actually, Trade Me was about 7 years from when we were working on it back then, just 3 or 4 of us, to when we had the exit to Fairfax in 2006. So, there were lots of opportunities along the way to, as the book title sort of alludes to, be wrong and learn from those lessons. So yeah, originally Sam and Jessie, and then I was number 3, and number 4 was my old friend Nigel Stanford, who joined the team shortly after that. But actually, for a long time, that was the team. We didn't really grow much bigger than that through those first few years, and experienced some pretty rapid growth then. But it was a pretty small unit.
Yep. I remember aged 20 or something receiving an A4 advertisement for Trade Me in my letterbox. And
Right.
it was printed on plain paper, thinking, and come check out our website. You can sell some stuff here. Is
Yeah.
what it said.
Yeah, I mean, most of the people who came to Trade Me in those early days were referred by other Trade Me users. Like, the most successful way for us to grow the site was to create great experiences for the people who were buying and selling, and they told their friends and family, and that's how we grew.
Yeah, and commercialization of even in the very, very early days, like generating revenue and finding, I guess, what your business model was
Yeah,
a journey of discovery. How did that unfold?
I mean, that was one of probably the biggest misstep that I was sort of just alluding to. Like, in the beginning, the business model for Trade Me and for Flat Hunt before that was effectively free classifieds. We had these billboards that Sam got at distressed prices in the early days, which said, only turkeys pay for classifieds. That was the sort of tagline for Trade Me. And the idea in those days, for those of us who are old enough to remember the dot-com bubble, was that advertising was kind of the business model that underpinned all of these free services. So we were out there trying to sell advertising on Trade Me to make it free for users, and ultimately failed to do that. Like, we sold minuscule amounts of advertising in the end, and it was only really, once we'd almost spent all the money we had and started to run out of time, that we turned our mind to alternatives, and that's when we implemented success fees, which became, the massively successful business model that Trade Me still uses today.
Yeah, I guess with the success fees, you have revenue that you can reinvest, add new features, build new functionality, grow the presence. Was that discovery of a commercial model that actually worked? How did that unfold? Did you suddenly realise you were onto something, that customers weren't going to not use your platform because of it? Or?
Customers had always used the platform. So in that first sort of year that I worked on the site, we went from 10,000 members to 100,000 members. So literally an order of magnitude kind of growth, which, that kind of growth doesn't happen often. And when it happens, you're literally holding on to the tail of the tiger as it runs away, So yeah, we knew we had a very addictive product. We knew we had a very, a thing that people love to use and saw value in. But the success fees was where we really started to tap into into the revenue model that would underpin that growth in years to come. But yeah, Trade Me was always had a pretty low cost, small team ethos, and that flowed all the way through. Like one of the numbers that melts people's brains in the book is that there were 53 of us at the time we sold that business. So even years later, the team hadn't expanded to hundreds or thousands of people.
Yeah. Okay. And one of the things you talk about a lot in your book, which we will, I guess, be unpacking as we go through our discussion today, and it's a theme that, as I mentioned before this call, really resonated with me, is everyone plays a different role in a success story like this. And
yeah.
What was your role in the first 3 or 4, and how would you compare that to? Don't need to name names per se, but like how do you compare that with others who were early in the journey?
I think this is another misunderstanding. So we're talking about how the missteps often aren't spoken about, and I think another mistake that we make when we talk about these high growth companies is we tend to ascribe one name to each successful company. So Trade Me, Sam Morgan, Xero's Rod Drury, so on. But the reality is those are just one of the roles that are required in order to create these successful companies. Like every company needs the crazy founder who's prepared to take that risk in the beginning, but every company also needs the first believer, the person who kind of gets in alongside them and kind of validates their craziness. And then they also need people who can fill the other roles that are required to grow the business. So, you talked about Jesse being employee number 2 at Trade Me. So Jess ran the operations at Trade Me for many years. So the customer support team and the trust and safety team and all of those kind of aspects of the business. That's a vital cog in creating that successful economic engine as well. And my role was software and product. Like we didn't really use the word product back then, but creating that user experience and actually building it and having it run. Like one of the real challenges with Trade Me was the scale. As I say, we went from 10,000 to 100,000 users in a year, and just keeping up with that is a bit of a technical challenge too. So there's lots of roles in these companies, and roles for any type of person to play. And I sort of wish we would do a better job of telling those stories, because then maybe more people like ourselves would see themselves in these companies.
I love all of that. When you reflect on your time at Trade Me now, having been in other businesses, and in the book you talk about being wrong productively. Are there any sort of things you could, you look back on in the early days and you're like, damn, that was so obvious. What were we doing? What were we thinking? What were we dreaming?
There were so many, honestly. I could spend the rest of this call just listing them off. But let me just give you one. Like one of the things that I spent quite a long time working on at one point at Trade Me was SMS bidding. And this was in the days before smartphones, remember? So everyone had, triple tap, Nokia phones.
Yeah.
And we had the idea that we could implement SMS bidding, and that was a big technical challenge. There was a lot of problems to solve with that, and I'm an engineer. That kind of appealed to me. I got stuck into that problem and went way too deep on it in the end, and the number of people who used that feature was basically the team at Telecom who paid us to build it, and a few other people who were my friends and family, but not many others. It was way ahead of its time. And that's a good example where it's a repeated pattern, because technical people are often drawn to the most challenging technical things that they can solve, rather than actually building stuff that people want and will use and will pay for. So there are so many examples like that from Trade Me and from Xero and the other companies that followed it, that in some ways those are the stories. Like it's those repeated missteps, but learning the sort of lessons from each of them as you go that ultimately create that success.
Discovering the way. I have to say, like that whole thing of like technology, people love to build cool tech, and that's generally speaking crass, perhaps, but what gives them their kicks, and but cool tech and what people want are not always the same.
Well, I mean, I think probably the single biggest personal lesson that I took from Trade Me was that discovery that what really makes me happy as an engineer is building things that are used. Like one of the beautiful things about Trade Me was we'd have 40,000, 50,000, 60,000 people online every night. And so, you'd build something during the day and deploy it onto the servers, and at night there'd be 40,000 people using that thing that you'd just made. And I found that deeply satisfying. And so, I guess one of the lessons that I learned was to kind of tie my success or enjoyment or satisfaction from the work to how it's actually used, rather than just how complex it was to build. And yeah, I think that's a really useful pattern for people who are kind of drawn to those technical challenges, is kind of follow the dots all the way through.
You talk about the Corin incident. What was the Corin incident, and why did it leave such a huge impression on you? And I guess it's something that's sort of you've thought about in subsequent.
People really love this. People really love this story.
Yeah.
It's actually the way I've written it, an amalgam of a few stories. This unfortunately didn't happen just once, but yeah, the story is in the book, which I'll try to relay for people listening. Is people now might be familiar with Corin Dan, the broadcaster on Radio New Zealand, but back then, many years ago, he was a junior reporter at TVNZ and was doing a story and asked us if we could update the listing so that when they filmed over his shoulder, it said Corin on the screen. And so, as we'd done hundreds of times, just updated the database directly to try and update his member name to be Corin, but messed up the query and ended up updating every member's name to be Corin. So all 30,000 odd Trade Me members that there were at that stage. So that was.
That's that moment when you get that knot in your stomach.
It's actually in your throat, in my experience. You have this awful kind of like you sort of can't breathe. You can't. It's just awful. And so. Yeah, like we quickly took the site offline, luckily we had a backup, so we started the process of restoring the database from the backup, but forgot to stop the automated jobs that were closing all the options. So people were still getting these emails saying, hi Corin, your option's finished, the winning bidder is Corin. Which obviously, once we discovered that, it was kind of like a second, oh no. And so then, we realised we needed to contact all these people who had been given the wrong details about their option. And so scripted a message to all these people saying, with the correct information. But unfortunately, that script also relied on the database, which hadn't finished being restored yet. And so all these people got these messages saying, hi Corin, sorry for the last message, incorrectly saying you and it was Corin. And the little cherry on the top of the story, the final kind of embarrassment in this kind of series of disasters was that the signature on that automated message would normally said regards Trade Me support. But what we didn't realise was that Trade Me support also came out of the database, and so it said regards Corin at the bottom of this message. So this is an embarrassing story to share. It's obviously a giant mistake, and sort of lived with the consequences of that for a while, but the value of that story for me over the years has been able to share that with other people, because these sorts of things happen regularly. When you're going fast, one of the consequences of that is that sometimes you make mistakes, and it's useful, I think, for me to be able to share that story with other founders as they've made their own similarly kind of embarrassing mistakes, to say, yeah, you might have messed up today, but you probably didn't mess up as badly as we did back then.
Well, you probably propelled Corin Dan's career forward and brand nationwide.
I think we should take credit for that, do you think? Yeah, certainly.
I think so, yeah. I'm sure you can monetize that somehow. Okay. The other thing you talk about is mindset, and the mindset of the different people in the different roles. Trade Me then went from 10,000 to 100,000, and then I don't know how many millions are on it now. But how did that shape your kind of maturity as a business builder, and then how did it once, I guess, take us through the ultimately the transaction, and you would have had a an inflection point, and then you would have had to, you touch on it in your book, you thirst for more.
Yeah, I mean, I guess the first part of that question is around that size of audience. Like by the time we sold it, we more or less had all of the connected people in New Zealand. Everyone who had an internet connection more or less was a Trade Me member. And so, yeah, I mean, there's a responsibility that comes with that when you have such a large consumer audience, and took a huge amount of lessons away from that in terms of thinking about creating software that even people who aren't comfortable with technology can use and find approachable. But again, there's always a yin to the yang, and I think one of the lessons for me moving into Xero was that sort of blind spot that created for us, those of us who've been part of that Trade Me story, because like we famously never spent any money on marketing, for example, because the best marketing for Trade Me was a great product that people loved and would tell their friends about, as I sort of said before. Then you move into other businesses and realise actually marketing is a really important function, because overcoming obscurity is pretty hard if you don't have this massively addictive product that you're making and building. So there were definitely some beautiful things about that experience, but some blind spots too that needed to be corrected later. But yeah, I mean, the line I like to use about the sale is, I think that day in 2006 when we sold Trade Me was the day that everybody else discovered what a successful business it was. Like, we sort of knew that for quite a while before that. Like, Trade Me had grown to the point where it was really generating a lot of cash and paying large monthly dividends to those of us who were lucky enough to be shareholders. And so, the surprise for everybody on that day when the sale was announced was the price. $750 million is a extraordinary amount to pay for a domestic business. But actually that price just reflected the value of the business that had been built underneath it. And so yeah, it was in some ways it was kind of a relief for that sort of to be known, if you like. We could sort of get on with the rest of our lives at that point.
Yeah, I mean, it's a wild journey, and I remember, I guess as you go and you've effectively maxed out your audience in New Zealand, in terms of the pure classifieds, obviously the diversified and
yeah, there was still
lines.
I mean, the revenue still continued to grow strongly for a few years after that, which was partly the justification for the price because of those verticals. Like, we'd done motors and property had recently launched, but jobs was next, and travel after that. So the next steps were reasonably clear at that point.
Yeah, and so at that point, you've gone through this massive journey. How did you move into Xero, and what was your role there?
So I didn't straight away. Like, I actually stayed at Trade Me for about a year after the sale, despite I had no ties, financial ties to the business, but I had a team that I'd recruited and quite a few loose ends. So I actually sort of continued to lean into that and work on it for a year. And the only reason I left really is I got shoulder tapped by Rod and the team at Xero as they were sort of ramping up for their IPO. And so the opportunity to take a role in the executive team there through that stage of the business was far too good an opportunity to pass up. And at the same time, that sort of came coupled with the opportunity to invest, which has turned out to be an amazing opportunity as well on top of that. So yeah, I sort of jumped from out of the frying pan into the pot, really.
Yeah, you talk about the opportunity to be wrong, and I guess in your book quite a bit. Was there a different culture between Xero and Trade Me? And what if you were to sort of compare or contrast, what would be the things you would identify there? And
yeah, a really different culture, and I've tried to describe that as generously as I can in the book, because again, there's pros and cons with everything. But Trade Me by that point was a very analytical, kind of fact-based team. We had a huge amount of data that we collected from such a large user base, a very active user base, and so we didn't really have to debate things too often, because if you bought good data to a prioritization meeting, for example, then generally the right decisions were sort of reasonably self-evident.
Measure everything you say in the book.
That's right.
One of your chapters, right?
We did. We had huge amounts of data, and it informed our decisions, right? And that was definitely the culture to it. Trade Me. It's like facts trump opinions, and it was quite jarring for me to jump to Xero then, because Xero's culture was very different. It was much more of a faith-based culture. We had to believe in this huge global opportunity that was sort of the promise of the business, but there was very little evidence of that. So there wasn't much to kind of cling to that actually gave you that confidence. And yeah, obviously very different businesses too in terms of selling to business customers rather than the general consumer audience, and also global rather than just domestic focus. So lots of differences, but culturally that was probably the one that jarred the most with me, and I sort of took that on a bit. It sort of became my job, if you like, to try and bring some of that Trade Me ethos to that team as we were going. So the example of that I use in the book is bank feeds. So back in those days, like automated, the ability to automatically import your bank transactions was kind of the killer feature of Xero. And I really vividly remember this one meeting where I just sort of naively asked the question, like, how many ASB customers do we have using bank feeds? And nobody knew. It wasn't a question that anybody had asked, and I think the reason for that is that the answer was uncomfortable. Like the answer was very few, and so yeah, like I guess my bias coming from Trade Me was I prefer to know, because then we can talk about how we might increase that number. So.
Yeah, but I get, was it perhaps a function of the different stages of the business? By that
Totally,
point,
yeah.
Trade Me was massive, and
that's right. And there was very little that we could lean on at Xero. Like the potential was all ahead of us, and so we had to believe. And if we didn't believe, we probably shouldn't have been in the team. But at the same time, I think that mindset of maybe we should assume that we're wrong and there's things for us to fix, rather than assume that we're right and we just have to believe more. That's kind of what actually gets you there.
Yeah, it's interesting that, isn't it? Reality versus the vision, if you will, and they don't always sit neatly together.
No.
How when you think about how Xero scaled, because it is a different business model, and it has a sort of a business to business and a business to client relationship with the accountants and the underlying businesses, and it sort of struggled with who its customer was, perhaps. And
certainly during my time there, yeah. Like I think, like you look at Xero now, and it's pretty easy to retrospectively tell the story about how selling through accountants effectively to small businesses has been a real river of gold for Xero. But that wasn't obvious in the beginning, and it certainly wasn't as easy as it maybe seems in retrospect. Like convincing accountants to adopt Xero during my time at the company was a very steep uphill battle. Most accountants in those days had deep ties to MYOB. That was the software that they knew and used in New Zealand, and they had good commercial arrangements around that. So convincing an accounting practice to switch to a brand new unproven platform with a totally different pricing model and all of the things that we were sort of doing differently was definitely not a no-brainer. So that actually took quite a few years to get traction. And again, this is one of those misremembered things, I think.
The myth.
The myth of up and to the right, certainly in terms of the share price. Like we floated Xero at $1 per share, and I think the low point was 79 cents per share. For a long time, it was underwater in terms of its IPO price, and probably should have been given the momentum and the traction that we had at that stage. So it took a number of years for that momentum to build, and for that go-to-market or distribution channel through accountants to get traction.
Was there I know you kind of you cast aspersions on the eureka moment in your book, but was there a eureka moment with accountants? Because they're it's a particular industry with particular needs and highly technical, very skilled, big commitment to their clients.
I mean, it actually happened after my time, so I tell the story secondhand. But yeah, I think there may not have been that singular moment, but I think there was a shift away from the idea that we could sell directly to small businesses and for that to be a scalable distribution channel, and the realization that accountants were going to be the gatekeepers to that decision. And yeah, I mean, if you look at the way that Xero behaved sort of from that point on, like accountants were put at the center of the story and given a lot of love by the company. All the XeroCon conferences where accountants are brought together and treated like heroes. That's not an accident. That was a very conscious strategy, I think, to center that distribution channel as the path to growth.
Yeah, okay. And when you were building all the features and technology in Xero alongside its distribution, how did you do that? How did you think about prioritizing those two different
Yeah.
streams?
So, I mean, this is again a misremembered thing, but like at the IPO, one of the features which was still sort of under construction was a fixed asset register, which is a pretty sort of fundamental part of any accounting system. But that was one of the blockers that we couldn't really bring on customers into the platform at that stage who had complicated fixed asset register requirements because the software was still under development. So, yeah, it's a good example of kind of building the plane as you fly it, and trying to respond to the things that you think are going to get the most traction with people, and that's a massive challenge for any product team. I think that requires a lot of internal debate and a lot of process around how you do that work, because there's always an infinite list of things that you could build or add to the product, and trying to choose the best ones to come next is much more art than science, I think, especially when you're doing it in the absence of a big user base already. So,
Teams. In both Trade Me and in Xero, you were leading teams. And how did you find the right people and decide that they were the right people for your teams? And
yeah.
would you think about it more and I'm hiring talent, or would you think about it more as in terms of I'm hiring an attitude and I'm building talent?
Yeah, and again, this is a distinction between the two. Like I helped build the team at Trade Me. Like a big part of my job was recruitment. I spent a lot of time on that, interviewing people or trying to define the roles that we needed to fill, and then onboarding them. I guess once we had hired people, which is a often overlooked part, I think, of that recruitment process. Bringing them up to speed to make them productive parts of the team. And yeah, I mean, we hired a very young team. We were young ourselves, but we also hired people who were young at Trade Me. Like I say in the book, we were pretty diverse on every dimension except for that one, apart from age. We were pretty, we were skewed young and also generalists. Like we tended to hire people who could do multiple things. So a great example of that, someone whose name is not well known in the Trade Me story, is Amnon Benor, who is a young engineer that I hired there, who effectively took over my role as head of product when I left to go to Xero. So hired as a software engineer, but eventually running the sort of design and user experience teams. And so yeah, people who can kind of span a little bit of breadth in the role and bring multiple sort of aspects of experience to those roles was I guess one bias we had for that. And yeah, the culture at Trade Me too was very much hire your replacement. So kind of the way you progressed within that organisation was to backfill yourself, rather than...
Interesting.
So yeah, Xero was again quite different because Rod and Hamish had a bit more money, and they'd sort of hired a more experienced, more grown-up team. And I came out of an executive role at Trade Me into an executive role at Xero, and it was much more a team of peers at that point in that sense, including some people who'd done some very grown-up roles prior to that. So an example of that would be Ali Grigg, who was the COO who'd come from Air New Zealand, where he was CTO. So he'd already been in an executive role in a publicly listed company. So yeah, it was quite different in that sense. But I think culture's the undersold aspect of all of these success stories. Like the culture in the team is ultimately a very important part of the success.
How did you shape the culture, or was it more that it just happened and you in retrospect can see what it looks like, or were you sort of actively involved
at Xero,
in
I thought about this a bit, because as we were just sort of describing, I didn't really know exactly what my role was. I didn't even really have a job description when I joined at Xero, and I quickly kind of latched onto that idea that if I can bring some of that ethos of an analytical approach and a sort of fact-based basis to making decisions to that Xero team, which was already a very impressive, accomplished team, then that's one thing that I could add to that culture and nudge it along, if you like, from that. And yeah, I mean, hopefully that when you look backwards, you can kind of retrospectively say the successful teams are the ones that you have multiple people doing that, bringing their own kind of skills and experience to those roles, and then working together and moulding them together to create a singular team.
Yeah. Okay. Did you change as a team leader through that time?
I think so. Yeah. I mean, less so at Xero because I wasn't really leading a giant team. Like I was contributing to multiple teams across the business. But certainly my time at Trade Me has been completely formative to the way that I think about growing teams and managing people and and recruiting and retaining people. I think those are two very separate jobs. But yeah, how you create that little sub-team culture within a broader company as well. Like, as Trade Me grew, our little team of engineers and product people sort of had to form our own subculture as well. And so, yeah, I don't ever remember sort of consciously thinking that's something that I need to get better at, but through osmosis, over doing it and kind of doing it right sometimes and doing it wrong more often, you kind of get better at it. So it's one of the things it's a muscle you can build.
Trade Me was unlisted at the time you were there, and then Xero was listed. Was there a difference in the discipline or the way you thought about, I guess, shareholder interactions that you felt as an executive on particularly on Xero?
Yeah, I actually don't think so. I never really experienced that. And I know that that's not universally true. I know a lot of people who work in public companies do feel that external pressure. And maybe it didn't impact me personally or us so much at that stage because we were also investors. Like, so many of us had tipped, significant amounts of money into that IPO or the pre-IPO rounds. And so, as I looked around the table, more or less everybody was also a shareholder as well as an exec or a team member. And so maybe that was the difference. It sort of, it wasn't like there was an external shareholder out there who was applying that pressure, because we were ourselves those shareholders, with that sense of pressure. And then the other thing too is what I said before, like the performance of the share price at that stage certainly wasn't anything to get excited about or to focus on. So yeah, I spent 0 minutes thinking about the value of those shares, and it was many, many years before I thought about selling any of those shares. So maybe that dynamic helped us avoid some of those common sort of public listed pitfalls. I don't know.
You then obviously did your time at Xero. It became huge, and is a juggernaut across the world now, which is a huge achievement for everyone involved. How did you end up deciding that it was time for the next thing, and how did you decide on what the next thing or things would be?
Yeah, and one of the recurring patterns in the book actually is that kind of the pendulum swinging between work and family. And so our second child was born literally in the gap between Xero and Trade Me for me. So one of the determining factors for me was kind of being able to take that opportunity to be a dad for a bit, and while he was still young, and we had an older child as well that was so yeah, it was really that opportunity to spend that time. And I sort of naively thought that I might do nothing. There's actually a chapter in the book called Nothing where I talk about this, and it was again it was kind of a painful lesson. Like I learned during that time that I'm actually quite poor at doing nothing. I get quite scratchy if I'm not doing that sort of stuff.
You need to feel purposeful.
Yeah, I'm definitely not good enough at golf to be retired. And also, I was only like 30. I was in my early 30s, and so it's kind of culturally unacceptable to be retired when you're that age, unless you're in All Black. So I sort of needed to do something else for my own sake and for others' sakes. And so yeah, it was a bit organic, but opportunity bites. If you are paying attention, there were lots of interesting people working on interesting things at that stage, and I guess I had some useful kind of experiences to share with them. So those opportunities ended up popping up.
How did you get involved with Vend? That's obviously another success story, and you stepped in not as an exec, more as an investor and
I was
mentor.
I was the first investor, and it was, eventually became chair of the board of directors, but in the beginning the board of directors was literally myself and Vaughan, the founder, so it was barely a board. I knew Vaughan from Trade Me actually, so we had worked with his previous startup on the travel site that we built at Trade Me, which is one of the last big projects that I was involved with there. And so I knew of him and had worked with him, and he got in touch, I guess, after I'd finished at Xero, and at that stage he was having a bit of a midlife crisis, if he was honest, and riding the length of New Zealand on a bike. And so he asked if he could stay with us in Wellington as he passed through, and I sort of reconnected with him there and got talking to him about this business idea that he was slowly forming at that stage.
You didn't hop on your bike too?
I did, yeah. I rode with him from Wellington to Otaki actually one day,
Right.
so it's a decent ride. And yeah, I was a very captive audience during that ride in terms of his pitch. So yeah,
Yeah,
I got
hard
to
to
hear all
show the
about it.
slide deck at the time, but
It's definitely one you want to be able to remember if you're the founder at that point, right? But yeah, the hills get a little steep as you get towards the top of Akataroa as well. So it's an interesting place to be pitched.
very good. And so then you helped grow that. What was your, as chairman, how involved were you? How involved do you think directors should be, and
I was
how?
deeply involved, and I guess I had no basis for that. Like I didn't know what patterns to follow there. I was sort of making it up as I went, and I had plenty of time, and I was interested in the business, and I really enjoyed working with Vaughan through that stage. Like it was a very small team again, similar to the Trade Me kind of size, and there were lots of things to do. So I just kind of rolled my sleeves up and did the things that I saw that I thought would be useful, including things like helping him with his first financial model and things that weren't necessarily my immediate skill set. But again, you learn by doing, and so I learned a lot in that time, and thankfully most of the decisions we made were good. I can't say we were 100% right, but we grew that business pretty effectively through those early stages on a very low cost model. Like we tipped in $100,000 at the beginning of that business, so it wasn't a massively well funded startup, but we managed to get it to a point then where it was kind of venture backable, and managed to get some various venture funds around the world over the years that I was working on it tipped into that company, and so it ended up being a well funded high growth business.
Fantastic. Learning by doing, writing a book, I guess, forces you to reflect upon things, and if you haven't done it, I've never done it. What was that experience like, and sort of casting yourself to focus on your journey, and then set a path for, in the book you talk a lot about policy and the ecosystem as a whole, which we'll touch on next if we can. But that journey of learning by doing, what did you learn about yourself in there?
So two things, I guess. One is I've actually been writing about these companies more or less the whole time. So I started a blog in 2006 when I was still at Trade Me, and the reason for that was to try and tell this Trade Me story a little better to help with recruitment. It was pretty transparent. But yeah, I think I learned over all of those years that I'd been writing about all of these companies that that writing's a muscle, really. Like you learn a lot when you sit down to try and share your thoughts about a topic in a short essay or in a blog post. It really forces you to understand what you actually believe. And so yeah, I actually used that as a tool over the years, quite selfishly, to kind of just try and settle on the things that I thought I understood. So for example, at Vend, after we'd gone through that process of pitching, international venture funds, you learn a lot quite quickly when you kind of get those repeated no's from big name investors. And so I sort of turned that into, these are the patterns that I saw, or these are the lessons that I learned, and shared that, just because you may as well, once you've written it down, publish it, right? So yeah, I knew the value of that from having done that a lot over the years. The experience of putting it all into a book really forced me to put myself in those stories a bit more. Like the things that I'd written over the years had mostly been my opinions about, external topics. But yeah, I think the thing that I have learned most from the process of actually writing it in a book form is some of the stuff we were just talking about before, like the different roles that people play and the roles that I played, and the experience of being in that role with people whose names are maybe more recognisable, or companies that are more recognisable. I think I took a lot from those sort of reflections, and hopefully as people read it, they can kind of do the same, and as I said before, hopefully see themselves in these stories maybe more than is usual.
Well, I certainly did, and the thing I love about it is it's not just a crash course in startup success; it's a crash course in startup reality, and you kind of debunk, or you go head on against a whole bunch of common, as we touched on, myths. So the myth of the eureka moment, the myth of the overnight success, the myth of the lone genius, and there's a whole bunch of others, for example. And and you get the sense when you're reading it that you've had to wrestle with, I guess, reality and the dream, and how the two coexist, and what's needed. Absent the dream, nothing would happen. You have that Steve Jobs quote at the beginning: only those who have a dream are the ones that do. basically. But at the same time, it's the dream isn't enough. It's necessary but not sufficient, let's say.
Yeah,
So,
that's right. It's a prerequisite, but it doesn't get you there. Yeah.
yeah.
Yeah, and I guess, I mean, when you sort of read all these stories back to back, you know, I've been punched in the face a number of times in these companies, right? And I think that's to quote Mike Tyson, not Steve Jobs, but maybe that's the other end of the spectrum is, you know, ultimately that does make you better, but it's pretty painful in the moment when you're learning those hard lessons. So yeah, it's like one of the things I've tried to do in the book is frame that in a way that people can actually use it, like that mindset of starting with the assumption that you're probably not right yet, and having that humility to be, you know, constantly inquiring, well, what are the things that we're doing wrong here? I think hopefully that lets you then make lots of small failures and learn as you go, as we were just sort of describing, rather than making those sort of big headline failures that, you know, are the big punches to the face that sort of knock you out. And, you know, that's happened to me a couple of times. I tell those stories in the book, but it's much smarter if you can avoid that. And I think you can, but only if you sort of start with that mindset and that humility around that.
Silicon Valley has this idea of fail fast, right? And then kind of alongside it is this concept is there's no point in trying to predict the future. You should discover it.
Yeah.
And that's something that doesn't sit well with the Kiwi psyche, right? Because it implies we hate failures, dare we say it, you know. We also don't really like people being too successful too.
Right, yeah.
So, you know, in the States, if you go bankrupt, it's a necessary path for your next venture. You know, being bankrupt implies that someone's actually previously been willing to back you.
I don't know. I wonder whether we have just a narrow spectrum of language. Like I described that experience of pitching to US investors, and at one stage Vaughan was asked, you know, how's it going? And said, oh, it's going pretty good. Which, you know, in New Zealand, pretty good means very good. Like,
Yeah.
pretty good is kind of the highest praise in some ways.
Totally.
And we have the same on the negative, like how's it going? If it's not great, it's kind of, you know, it's like not great is actually terrible usually. Yeah. And so we just sort of squish the range of language that we use around that. Whereas you go to other places like the States and, you know, how's it going? It's going fantastic. I'm smashing it, you know, world beating, whatever. And, you know, it's also not really true often. So yeah, I think there's again a quid pro quo to that, which is we tend to be a bit more honest about our reality, I think, in that narrow range. So yeah, I don't know. It doesn't sit well with me that we put failure on a pedestal. Like having worked on ventures that have failed, I know from firsthand how painful that is, and especially if you're the founder, because like as an investor, you're, you know, like a grandparent to a venture. But as a founder, like you're all in on that, and when it fails, it really hurts, and it's not great, and it's certainly not something that I think we should advise people to aim for. Like the whole idea of that fail fast mentality is experiment early and avoid failure effectively. But it's amazing how often that gets kind of distorted by advisors who have never really done it themselves, never really failed themselves, into this idea that if you've failed, that's something to celebrate. And I think you can ask much smarter questions around that, which is, you know, again, what did you learn from that? Like one of the questions in the book that I've asked painfully in situations where companies have failed is like, do companies like this sometimes succeed? And if the answer to that question's no, then that's not a particularly useful failure, is it? You didn't really learn anything. You sort of already knew that your idea wasn't very good. And if the answer is yes, well then that's interesting. Like what did you do differently that meant that your company failed where others have not? And, you know, there are some deep lessons in that if you're brave enough to kind of ask those hard questions. That for me is a much, much more useful mindset than just saying, you know, you failed, congratulations. It's like, yeah, I don't know. That doesn't feel right to me.
No, and I think what's happened is it's probably, like many things, the headline gets distorted, right? And we grab it and run with it, but actually most people in the States or anywhere, Silicon Valley, they don't operate like that. No one
No,
wants to be in that,
that's right. That's right. I think you did touch on one thing which is certainly true internationally, which is people aren't ostracised for their failures over there as much as maybe is perceived to be the case here. But yeah, I like to inquire about that too. But let me give you one example specifically from the book. I talk about accelerator programs, which is kind of proliferated everywhere now. There's many opportunities for people, young founders, to join a cohort of startups in a program. And those programs will often kind of promote this idea of fast failure, like the idea of an accelerator is you spend maybe 12 weeks or something like that, compressing the early stage of your business into that program, and then you have a big pitch night at the end of it, and maybe you get investment, maybe you don't. But that idea that everything's kind of accelerated is kind of often promoted as, if it's not going to work, you'll find out much faster. It's like, I'm not sure that that's the right model. And I think the best evidence I have for that is when you push back on the people who run those programs and say, well, how are you failing fast? And often their answer is, well, it takes 10 years for an ecosystem to build, so it's too soon to tell. I'm like, wow,
Yeah.
you can't sort of believe both of those things are true.
How do those coexist? Not neatly, that's for sure.
Yeah, that's right.
So if, when you, having gone through the New Zealand entrepreneur journey, technology journey, obviously you're still deeply entrenched in it, but what would you like to see changed in how we as a country support it? And support founders and support founders taking their ideas to market, whether through funding or whether through distribution or whatever it happens to be.
Yeah, one of the things we talk about a lot when you talk about startups collectively is the ecosystem of startups. That word gets used a lot, or NZ Inc. is kind of the label that often gets attached to that, which I always find a bit confusing because I'm not sure why we use a US company naming convention for New Zealand startups. But this idea that startups kind of grow together, I think, has become quite pervasive. And I have a really different mental model of that. Like, my mental model of an ecosystem is really just the collective noun of startups, of founders and their companies. But often when we talk about the ecosystem, the focus gets all on the layer of stuff that sort of gets wrapped around that. So the accelerator programs like we're talking about, or government funding agencies, or shared working spaces, or business awards, or those sorts of things, tend to soak up all of the oxygen and all of the funding, unfortunately. And often forgotten in all of that is the individual founders and the companies that they're building and the teams that they're building and the people who are working on those companies. And so, I certainly, my approach over all the years is to try to avoid getting too distracted by all of that noise in the ecosystem, and to focus on the small number of founders that I can work with directly and try to help them to be as successful as they can. And so, there's this irony which is poorly misunderstood, which is, in my opinion, the biggest contribution any one person can make to the ecosystem is to make their own company great. And if enough people did that, then we'd have a lot more startups than we have now, and we'd have a much stronger ecosystem as a result. Probably even have more funding, because the exhaust of a successful company like Trade Me or Xero or Vend is capital that you can reinvest in more companies.
What do you think the optimal government relationship with the ecosystem, in inverted commas, should look like then?
Yeah, I think there's actually some really tangible things that government can do at the high growth stage, and I've personally benefited from that, and the companies that I've worked on have benefited from that. So when you get to that point where you're expanding internationally, or where you've got international investors, all of those things, there's definitely things that agencies like NZTE, for example, can do to help companies at that point. And it's an assist, it's not a kind of lead role, but there's definitely things they can do to help. I think, unfortunately, we've had this view that startups are kind of like a casino, that we just need more of them and then we'll have more winners. And so the focus has always been much more at that very early stage and trying to get more people to start companies, or keep companies alive for longer at the very beginning, rather than at the high growth stage. I just think that mindset ultimately is not going to serve us. Venture is a very power law kind of outcome thing. It's so it's a little bit like an executive at a Hollywood film studio, for example, saying we haven't had enough big hits, we just need to make more movies. It's like, well, actually that's not true. Just more movies that are not good is not going to get us there, and same with startups, like just ploughing more and more money into that base layer, trying to convince more people to start, doesn't actually create more high growth companies necessarily. So
It's interesting, isn't it? Because I wrestle with this when I sort of observe the market, if you will, but at the same time, we accept that we're not very good at predicting what's going to be successful, at the very early stages.
yeah.
So shooting more darts at the board, so to speak, would make sense, arguably. But at the other hand, the idea itself isn't what creates another Xero. It's the ability to have an idea, develop it, and scale it.
Plus, the thing the question that I love most asking startup founders is, what's the constraint? And I think you can apply that at the ecosystem layer as well. Like, what's actually holding us back from having more of these companies, and how well have we understood that? So in the book, I talk about these programs that we stand up. Really, there's 4 questions that they should be able to answer before you even invest anything materially in them. So if I just run through those quickly.
Please.
The first question is, who are you trying to help? Like, this is, again, Steve Jobs kind of inspired. Start with the customer and work backwards to the intervention or the product or the technology. Like, so who are you trying to help? What problem do they actually have? Like, what constraint do they actually have right now, and how well can you articulate that? And then the third question is, what can you do to remove that constraint? And so many of these programs fall over at that point, because even if you can identify somebody that you want to help and you understand the problem that they have, it's not always true that you can remove that constraint with them, or that money removes that constraint with them, or a government agency removes that constraint for them. And then the last question, the one that we almost universally ignore, is how will you know that it works? Because if you can't define that in advance, then you're not really throwing darts at a dartboard. Like, in a game of darts, you know it works because you hit the right number that you're aiming for, right? But if you're just throwing darts at the wall and then drawing a dartboard around wherever they land, that's kind of actually what we've done often. And so, yeah, like, if you can't articulate in advance the experiment that you're actually undertaking to know whether or not you're removing those constraints for those people you're trying to help, then you kind of get 10 years into it and you've spent billions of dollars on it and you just don't know. And unfortunately, that's where we've ended up with a lot of these programs in New Zealand that have been kind of set up with good intentions to try and grow the ecosystem and help founders and all these things. And actually, if you look at the companies that have been successful, including all 4 of the ones that I've written about in this book and others that I've had the privilege of working on, they've often come around those things rather than through them. Xero didn't start in some business incubator anywhere. It started in an apartment in Wellington. Vend was in a corner of an office that was leased by another startup. It was just Fawn and a couple of guys and myself kind of making stuff up as we went. So I think we also misunderstand the history of the things that have been successful, and so it's easy to then assume that all the things we've done have led to those successes, when actually that isn't often true.
I was just thinking, when you were talking about the dartboard, I love that. But as you were talking about the dartboard, there's another myth in there, which is the myth of the pivot, perhaps, where you throw your dart somewhere in the room and then you realise you've hit something, but you don't actually know what you've hit, and so you shift your business to that.
This book is full of sporting metaphors, actually, and pivot is a good basketball metaphor if you're really paying attention to it, right? So the key to a pivot in basketball is one foot has to stay grounded. So it's not like completely reinventing what you're doing. It's taking one thing that's working and changing one thing that's not working, right? Yeah. Again, it's a language. Like, I think people have heard the word pivot. They've heard successful people talking about pivoting, and so just like failure, then this sort of idea grows that, all right, what we need to do is pivot. And it's like, well, maybe not. What you actually need to do is think about the problem that you have.
Yeah. Rowan, hey, I'm conscious of time, and you're a very busy individual. Thank you so much for joining us today. It's been a really, really fantastic discussion. For anyone who hasn't read the book, I strongly encourage you to go out and grab it. It's available in all good bookshops and online. And I'm looking forward to watching and seeing what other ventures you get involved with over the coming years.
Thanks for the conversation. It's been really fun.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds Kiwi Saver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.